Hey everyone, in this video we're going over Microsoft stock. We're going to decide, is Microsoft overvalued at today's price? We're going to give you some assumptions and we're going to decide what a fair value for the stock is. Before we get into it, if you could smash the like button, it really helps the YouTube algorithm. And if you haven't subscribed to the channel, please subscribe. Now let's get into it. First, it's important to note that Microsoft is a great company. But for this video, we need to decide, is it a great investment? A lot of times investors struggle between deciding to invest in companies that they love and think are great companies versus looking at the fundamentals and truly deciding, even though it's a great company, does it make sense to buy at the current price it is? So how big is Microsoft? Well, the current stock price at the most recent close was $314 a share. And based on their outstanding shares, that gives Microsoft a market cap currently of $2.36 trillion. So we're not talking about a small company by any means. This is one of the largest companies of all companies on the stock market. Now, their net income in the trailing 12 months was $67.88 billion. That is how much profit they had in the past 12 months. Now, with knowing what their earnings are, $67.88 billion in the past 12 months of net income, we can see that you're paying 35 times earnings at the current level. Based on where the stock price is today, the share price, you're paying a 35 PE if you're buying Microsoft today. Now, for those that aren't aware what a good PE to pay is, 35 times earnings, that metric alone is extremely high in my opinion. But you should have a somewhat high PE when you're a growing company. The question is, how does it compare to its peers, most of big tech? Well, Microsoft we saw was 35 times. Apple has a PE of 30 currently, Google has a PE of 26, and Facebook at 24. The lower the number, the better, because you don't want to pay a high price for a company you're investing in. But obviously, it all depends on the growth and where you think the company will be in the future. But on this metric alone, Microsoft is much higher than its peers. You're paying a premium compared to Apple, Google, or Facebook. So the question is it growing faster? And I did a video on Meta Platforms, Facebook stock, talking about how it's the cheapest of big tech not too long ago. I highly recommend you watch that video. So you could say, pay a higher PE if the company's growing at a faster rate. But the thing is, over the last 5 years, Microsoft has an average growth rate of around 13.76%. Yes, in the past year, it grew at a higher rate, closer to 20%. It was just under that. But the other companies, Facebook, its average growth rate over the last 5 years was almost 36%. Apple's was around 22%. Amazon was around 30%. And Google was around 23%. Every single one of these companies has a higher growth rate when you average the past 5 years than Microsoft, yet they trade at a lower multiple. And if you just want to look at the most recent year where Microsoft had just under 20% revenue growth, Meta had 42% in the most recent year. Google had almost 40%. Apple had around 33%, and Amazon had around 31 to 32% or so. So Microsoft had the lowest growth rate in revenue in the most recent year of these big tech companies, and the lowest when you take an average of the most recent 5 years. So all in all, it is fair to say it is not growing faster than these other companies as far as revenue is concerned, yet it trades at a higher PE. Now, these things on its own do not determine that it's not a good investment. The only way we can determine if it's a good investment or not is to make some assumptions about the future and then run the numbers. So first, revenue growth. Last year, Microsoft had 19.8% revenue growth. Historically, over the past 10 years, Microsoft has had an average revenue growth of 10.4%. Typically, the larger you get, the harder it is to grow at the same or a higher rate. Now, over the next 5 years, what will the growth look like? I think it's going to be 20% more than the 10-year historic number. So I think a fair revenue growth rate going forward for the next 5 years is around 12%. But this is being conservative because when you make an investment, you want to be conservative. The profit margin, the past year it was at 38.5%, but if you look over the last 10 years, it was an average of 27%. Well, over the next 5 years, I'm going to assume that they can hold a 35% profit margin, slightly under the most recent year, significantly higher than the average over the last 10 years. And lastly, you have to give it a fair multiple. What will Microsoft's PE look like in 5 years from now? Well, I believe the multiple should be around 17 to 25 times earnings due to steady growth ahead, but not insane growth. And for this purpose, I'm going to basically use 22 times earnings in 5 years as the multiple. So 5 years from now, I would not be surprised if Microsoft had a PE of 22. So the assumptions again, 12% revenue growth year over year for the next 5 years, 35% profit margin, and a PE of 22 in 5 years' time. Now, when you buy a stock, you want to make a return. So with the assumptions above, if we want to make 10% each year for the next 5 years, we can calculate what you'd have to pay for the stock today. A fair market price for the stock today to make 10% a year going forward for 5 years would be $240 a share, assuming that our assumptions were correct. If they have 12% revenue growth each year, if they stay at a 35% profit margin, and if their PE ends up at 22. Currently, the stock is $314 a share. So clearly, I believe Microsoft is overvalued significantly and needs to drop around $70 a share to get to a fair market price. Now, obviously, if you adjust the assumptions at all, it will have a major effect on where the stock price should be today when you're buying it. But the important thing is you should be extremely conservative when you make assumptions so that you know you're getting a fantastic deal. You don't just want an okay deal. So by being conservative, you're protecting your downside. If you're wrong about things to the downside and you made very conservative estimates and assumptions, you're going to be getting a really good price. Yes, you could put some higher numbers in, and with those higher numbers, you can get you can justify buying Microsoft at today's price. But you need them to execute flawlessly. So I'd rather not take the chance of them executing flawlessly, even if they very well may do so. I want to buy a stock where if they execute flawlessly, I'm going to make a tremendous return, not just 10%. And if they execute just okay, I'll still make a lot of money. So it is important to have a cushion. It is important to buy with conservative assumptions and at a very good price, and then hold for the long run. Bottom line, I don't think Microsoft's a buy. I feel it's overvalued at today's price. I appreciate you watching. If you made it to the end, please like the video, subscribe to the channel if you haven't subscribed. Let me know what you think of Microsoft in the comments below. Appreciate all of your support. Until next time.